IUL made easy. What is Max-Funded IUL? Okay, get ready. In this episode, I'm going to clarify what IUL is. I'll keep it as simple and sincere as I possibly can. That's called the KISS method, keep it simple and sincere. Because I am definitely sincere that I think that most Americans ought to consider a Max-Funded IUL as probably the foundation of their entire financial plan, far more than putting money in traditional IRAs or 401ks or what have you. So get ready. Let's keep it simple. I'm going to go through what it isn't, what it is, how it came about, and why it's so magic, why it is the dream solution for many financial goals for most Americans. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets, minimize tax, and empower what I call their authentic wealth. If you've watched very many of my 2,000 YouTube videos on this channel, you quickly realize that I'm very partial to my favorite financial vehicle for many financial goals, a properly structured max-funded IUL. Having said that, I don't recommend you put all your money into IUL, but I do recommend that 40 to 60% of your income at retirement not even show up on the front page of your 1040 tax return because it's tax-free. Okay, and that's generated by having an IUL portfolio. Not for all your money, you should diversify, but for a pretty good chunk of it, depending on how much income you want to be totally tax-free. So let's get into what IUL is, and I'm going to try to keep it as simple as possible. First of all, as a financial strategist, I've been teaching this for years. You have to understand the key elements of a prudent investment. Any place where you put money, okay? So most advisors actually get these in reverse order, or at least investors do. They're always going after rate of return. That's the most important thing, and they give up safety and liquidity. So the key elements of a prudent investment in order are, number one, liquidity. The ability to access your money when you need it. If you can't access money when you need it, if you get disabled or unemployed or something happens, that's when most people get into trouble and they lose a ton of money. If you can't access money out of an IRA or 401k without incurring a 10% penalty or a tax, or you have to wait and sell your house or that real estate or refinance it, that's not liquid. Okay. Number two is safety. Safety not only of the institution, the safest institutions in America, the multi-trillion-dollar insurance industry is the backbone of America. It's where banks and credit unions put 30 to 40% of their Tier 1 assets to increase the safety and the rate of return. But safety of principle, whatever I set aside, I don't want to lose. And in a year, I make money. I don't want to lose in future years money I made in previous years. I want to lock in my gains and reset every year so I never lose in future years money I made in previous years. Most financial advisors don't know how to do that. Third would be a rate of return. You don't need pie-in-the-sky rates of return. If you earn a rate of return of 7 to 10%, that will usually outpace inflation, but you've got to be able to diversify and rebalance, which you can do with IUL. And then your average returns will bump up to 11 to 14%, and you can earn 11 and net 10 cash on cash, so that every $1 million you accumulate can generate $100,000 a year payout without depleting principal if you live to be 120 years old, okay? Rate of return has to outpace inflation, right? And then you want to have tax advantages, and you're going to see that nothing else comes close. So I keep it simple. You can score any investment in America on a scale of 1 to 10, a place where you put money, a scale of 1 to 10 based on these 4 criteria. So the reason why I like to do this is because what I call the risk-return paradigm. And I used to have this in many of my books. I've been blessed to have authored 12 best-selling books thus far. And so I would list 16 general categories of investments ranked from highest risk to lowest risk. And then I would apply these tests. The first one, liquidity. This many of these investments do not pass the liquidity test. You cannot access your money quick enough if you need it. Or if you do access the money, there's a 10% penalty. It triggers tax. It's not really liquid. And so people don't touch it. This many more don't pass the safety test. You can lose your principal that you invested, okay? Even that happens with real estate. You can invest in real estate and it can go down in value. Hello? Rate of return. Now, to pass that test, you've got to earn a rate of return greater than the inflation rate. You can't be rowing upstream, so to speak, at 1, 2, 3 miles an hour or interest in a bank or credit union when the current of inflation is coming down at 9. You're going backwards. If you understand how money works and you want to become your own banker, you have to have a rate of return greater than the cost of the funds, okay? This is business. You hire employees, you buy equipment, not because you just want to shell out money for an expense. You hope the employee or equipment makes you more than they cost you. That's what I'm talking about here. So there's only 3 survivors after applying liquidity safety rate of return. When I apply the 4th one, there is only 1 out of these 16 that accumulates money totally income tax free, allows you to access that money totally income tax free, including all the gain, and you don't have to wait till you're age 59 and a half. There's no 10% penalties. And then at the end of the day, when you die, somewhere down the road, none of us are getting out of this life alive, whatever you leave behind transfers tax-free, and it usually increases or blossoms in value, okay? Nothing else does that except number 12, a max-funded insurance contract. So IUL is my favorite choice because all these others are eliminated when I go through the laser test. Let's do it on a scoring system. You can score any place where you put money, an investment, on a scale of 1 to 10 based on these. Max-Funded IUL knocks the socks off of all other investments by far. When we talk about liquidity, it scores at least 8 out of a possible 10. A lot of investments don't even score 4 or 5. And when we come to safety, man, it's 9 out of 10. It's weathered the Great Depression with flying colors. 2008, not one single legal reserve insurance company went under in 2008, even though 400 banks went under, 900 more were on the brink of going under, okay? When we talk about rate of return, it scores at least 8 out of 10, okay? I've always outpaced inflation with my money in IUL. When it comes to tax advantages, nothing else does what I just said in the Internal Revenue Code. Accumulates money tax-free, allows you to access that money tax-free, and when you die, it blossoms and transfers tax-free. I've taught advanced continuing education to CPAs and tax attorneys for years. I've always asked them, show me any other financial instrument in the Internal Revenue Code that does that. They've yet to show me anything, okay? So it scores, when you add these 4 numbers up, that equals 35 out of a possible 40. There's no other place to put money that scores 40. But most people in America have their money in IRAs or 401ks, mutual funds, annuities. Those only score 18, 20, or 22 out of 40. So max-funded IUL, it's not a little bit better. It's a whole lot better than where most Americans have their money, okay? Okay, let's also make it easy. I like the story of the 3 little pigs because money has to have a home, okay? You have to park it somewhere. I choose to keep my money safely tucked over here in a house of bricks if I'm using the metaphor of the 3 little pigs and the big bad wolf, okay? Why? Because out of all these places over here, a max-funded insurance contract, structured correctly, funded properly, passes liquidity, safety, rate of return tests, and tax advantages with flying colors over these others here. So that's why I choose that one. But here's what I mean. This is where I have my money. I own real estate. I benefit when real estate does well and goes up in value. But when it goes down in value, when the big bad wolf, when the recessions happen, like 2008, when my house went down in value from $1.5 million down to $1.1 million, I didn't lose one dime. I didn't lose $400,000 because my real estate equity wasn't here, it was over here, okay? Earning 3 times more than the cost of the mortgage. I was in control. I benefit when the stock market goes up with Index Universal Life. If it goes up 8, I usually get credit 8 or 12 or whatever. But if the stock market, if the big bad wolf blows down the stock market, pandemics, recessions, terrorist attacks, I don't lose. I can sleep when the wind blows. I benefit when the market goes up, but I don't lose when the market goes down. I keep it safely tucked in a house of bricks. Does that make sense? I'm just trying to make this easy for you. So if you want to get a little bit more technical, what is it? Well, in the Internal Revenue Code, sections 101A, 72E, and 7702, what is Max-Funded IUL? It's a property structured max-funded insurance contract where you're trying to get the least amount of insurance the IRS will let you get away with, okay? Because you're using it for living benefits. This is dictated by two tax citations, TEFRA and DEFRA, which were passed in 1982 and 1884, that dictates the minimum amount of insurance required based upon your age, gender, and health. But it gives parity, okay? It doesn't matter if you're a 22-year-old athletic marathon running female, or a 60-year-old or a 78-year-old friend of our family who had 3 blocked arteries, adult onset diabetes, a prostate cancer episode, 6 sisters, all predecease him, and 3 brothers predecease him. He wanted to put $500,000 into a universal life back in the 1980s. He wanted to earn 11 and net 10, which he did. He put in $500,000 and immediately started pulling out $50,000 a year tax-free because the cost of insurance was only using 1%, because the amount of insurance required under TEFRA and DEFRA at age 83, even with bad health, was the same cost as a 22-year-old taking one of these out. The cost was the same. The amount of insurance was less for him than a 22-year-old was required to have, okay? So, and the older you get, the cheaper it becomes as you fund it. Now, if you don't understand this, you need to watch some other episodes on here, but have you ever seen an insurance policy that gets cheaper as you get older? All these myths out there, oh, this is gonna crash and burn, it's gonna lapse. No, it isn't. The cash value in property structure max-funded IUL usually grows to exceed the death benefit within 11 years. I'm going to show you this in a minute. Now, you have to comply with TAMRA, which tells you how fast you can fund it. But now it accumulates my money tax-free. I can turn on tax-free income so that every $1 million can generate a 10% payout, $100,000 a year of tax-free income from age 65 clear to age 120 without depleting principal. Nothing else comes close to that. A whole life policy can't do that, okay? So folks, I compare it metaphorically to a bucket. So what is Max-Funded IUL? It's a bucket, it's a repository where you're trying to structure it to accommodate the amount of money you want to put in, and you want the minimum death benefit. You could buy way more life insurance. That's not the objective. So you fill it up as fast as the IRS allows, and it turns into a tax-free cash cow. So let me give you an actual example here. IUL, Max-Funded IUL, if I had a 60-year-old that wanted to reposition $500,000 to increase what? The liquidity of that $500,000 over where they have it invested right now. In IRAs or 401ks in the market, in rental properties, in the bank, wherever, okay? They want to reposition underperforming or non-performing assets to increase liquidity, safety, rate of return, and tax benefits. So they come to me and they say, I want an IUL policy to accommodate $500,000 because I want the $500,000 to grow as fast as possible tax-free so it will generate tax-free income. You got it? That's what Max-Funded IUL is. It's for living benefits. So you take the least amount of insurance you can get away with. It would be about $960,000 to $1 million. Sure, he could buy way more life insurance than that with $500,000. That's not the objective. He wants the least amount, okay? That's dictated under TEFRA and DEFRA. Now, the fastest he can get it in there under TAMRA would be, maybe $125,000 the first year. He can put that in the first day of the first year. He can put in another $125,000 the first day of the second year. Now, 1 year and 1 day into this, it's half full because he has to comply with TAMRA. If he didn't do this, then it would turn into a MEC, a modified endowment contract, and now it's taxable when he starts income. He wants tax-free income, so he has to comply with TAMRA. 2 years and 1 day, he can put in the next, and then 3 years and 1 day, okay? So he can get his $500,000 in there as fast as, 3 years and 1 day, 4 years and 1 day if push comes to shove. But now I've complied with TEFRA, DEFRA, and TAMRA. Now it's a cash cow. What did I say earlier? You're self-insuring. When I have 500,000 in there, if I die, the death benefit is still only $1 million. That's actually a positive because the net amount at risk is the difference between my money and the original death benefit required to make sure it's tax-free. The insurance company, the spigot on the bucket, the cost of the insurance is only charging me for the net amount of 500,000 if I died, because they're going to have to pay out $1 million, but 500,000 that they're going to pay me was my own money now. But see, I didn't do it for the death benefit. I wanted that cost to get cheaper as I got older, so I wanted my money to qualify as part of that death benefit ASAP. Now, my average return since 1980 has been 9.62%. If you divide 9.6 into the rule of 72, money will double every 7.5 years. We've had people put in 500 grand. It doubles to $1 million in 7.5 years, to $2 million in another 7.5 years, to $4 million in another 7.5 years. And by the 30th year, it's now worth $8 million, and it's generating $800,000 a year of tax-free income. Show me any whole life policy that can do that. You will not find one that'll do that. Show me any IRA or 401k that can do that. Folks, 500,000, when it doubles to $1 million in 7.5 years, what's the cost of insurance now? Because my money equals the death benefit. I've self-insured. You got it? Now, technically speaking, if I died, the insurance company is going to pay out $1,050,000. They have to pay me 5% more than my cash under TEFRA and DEFRA. But they're only charging me for $50,000 of insurance. My insurance, 11 years into this, is 1/20th what it was when I started. The insurance is getting cheaper as I get older. You can't believe how many agents don't understand this, how many people don't. So the cost of $50,000 of life insurance now at age 70 is dwarfed by the interest I'm earning on $1 million. If I started taking out $100,000 a year, tax-free income, that's fine. If I don't need the money yet, $1 million in another 7.5 years doubles to $2 million. If I died when I have $2 million, the insurance company pays me out $2.1 million. But they're only charging me for $100,000 of actual insurance cost. Even though I'm older, the amount of insurance I'm paying for is 1/20th what it used to be. And the interest on $2 million dwarfs the cost of the insurance. Folks, this is what Max-Funded IUL is. I compare it to a 5-story building. If the IRS said, Doug, you can build a 5-story building, and if you'll just rent out the first floor the first year, and then the first day of the second year, you can fill up the second floor. And then the third floor, fourth year. Then after you filled it up, okay, it turns into a tax-free cash cow. All of your rental income forever after is tax-free. That's a Max-Funded IUL. You comply with the least amount of insurance and fund it as fast as the IRS allows under TAMRA, and it turns into a tax-free cash cow. What else is Index Universal Life? It allows you to participate when the market goes up. It's called indexing. Cresmont Research studied from 1960 to 2010, a 50-year study, and they said, you know what? Most 10-year periods, you'll have 7 up years compared to 3 down years. The Great Recession, 2010, there are 5 down years compared to 5 up years, and yet our clients doubled their money during that time period, tax-free, with IUL. But it was Cresmont that said, you know what, if you just eliminate 100% of the lost years, the 30% of the years where the market's down, just eliminate them, you would only need 25% of the up years to outperform the market by not losing money. That's Warren Buffett's rule. Don't lose money. His second rule was don't forget rule number 1. So here's how it works. A lot of times our clients will end up with, $1 million, $5 million, $10 million of cash value. It doesn't matter. You can extrapolate from this. But if I have $1 million in my IUL policy and I feel bearish about America, I think we're headed for a recession, let's say, I can just settle for the general account portfolio. Now, ever since Universal Life was introduced in 1980, I have earned as high as 15.5% from the general account portfolio rate. That's what the insurance company is earning on their money. When interest rates were high, I got credited as high as 15.5%. I've been credited as low as 4%. So let's take the low. If I feel bearish about America in 2008, I could have just said, just give me 4%, 40 grand on my million tax free, which would have been wonderful because banks were not even paying 1% back then. But if I feel bullish about America, I think that the economy is going to go up, which, during boom times, then you say, hey, I want to protect myself in case I guess wrong, but I feel bullish. So I am willing to relinquish the interest on my million, this 4%. You can take that 40,000 of interest on my million and do whatever you need to do to have the wherewithal to credit me whatever the market does. So they take the 40,000, I'm talking about the insurance company, and they fund an options budget. They're the number one purchaser of options in the world. They buy them hourly. And that gives the insurance company the ability that if the market is up 8% that year, they'll pay you 80,000. Because 40,000 of options doubles to 80. Hello. Or it triples to 120,000. If it goes up to 12, they'll have 120 grand to pay you. They wouldn't offer it if they couldn't do it. It's like, how can they afford to do that? Then you don't understand options. But if you guess wrong and the market tanks, if you had your money in the S&P, your million in 2008 would have dropped to 600 grand. Our clients didn't lose a dime in 2008. You still have your million. The options expire worthless. Zero is your rate of return, but zero becomes your hero because you don't lose 40%. Does that make sense? This is how we explain it in the book with a diagram. So if you want to learn what IUL is made easy, study figure 6.2 in the book I'm going to gift you here in just a moment. But here's what it does. This is the Great Recession that I was talking about. November of 1999, ending in November of 2012. Money in the S&P. If people accumulated $1 million and their IRA 401k nest egg, they saw that $1 million nest egg dwindle down to $600,000, $700,000 in 3 years, 4 years. They felt like they'd lost their future. It took 4 years to make back what they lost. They had to put off retirement 7 years. Then, as Warren Buffett put it, he said, when the tide went out in 2008, it revealed who was swimming naked. They weren't protected. They lost again. It took 4 years to come back to break even and finally have $1,046,000 for the million you started with 12 years earlier. That's a pathetic 1/3 of 1% compounded rate of return. Let's say we just measured from 2007 to 2012. 500 grand would have gone down to 314 and barely been back to 497 in 5 years. People with Index Universal Life with a measly cap of 10.5%. Our clients had bigger, higher caps than this. 0, 0, 10.5, 10.5, 10.5. They would have had 691,000 instead of not even coming back to break even. This is as conservative as I can show you. So folks, what I wanted to accomplish in this episode is to make IUL easy by showing you how powerful it is, what it does. If you really want to understand the intricacies of TEFRA, DEFRA, and TAMRA, and why it's a sacred tax-free cash cow in the Internal Revenue Code, you can read my book. But take my word for it. If you sit around and you don't believe it because you've never seen one, that's like saying, well, how do you know you have a brain? Have you ever seen that? That's stupid reasoning. I can show you dozens. Go on my YouTube channel and see all the IUL policies under the subset playlist, Does IUL Work? Because it works for the people who employ them, who have it structured correctly and funded properly. I don't want you to miss out. So I recommend you claim a copy of my book and reach out. You simply go to laserfund.com or click on the link below. You can buy this on Amazon for $20 up to $60, and if you do, thank you, but I'll gift you a copy free. I do require a little bit of skin in the game. Come on. If you go into Laser Fund, I want you to contribute towards the shipping and handling, a nominal amount, but I'll pay for the book. I'll fire it out to you, hard copy, via priority mail. And while you're in there claiming your free copy, if you'd like to listen and learn or watch and learn, there's options there for a nominal investment. And it will be a game changer for you to not outlive your money when you get educated. You can even schedule an appointment to talk to an IUL specialist with no cost or obligation while you're in there. You can schedule to attend a free educational webinar that we teach on a weekly basis. But what I'm telling you is this is not about me. This is about you. I want you to be financially independent and not outlive your money and be immune from taxes, inflation, and market volatility. You got it?